So I hope you are fine and in good health. This is your teacher Haris Bhatt, and you are seeing my YouTube channel Learn Accounting with Sir Haris. So today we are going to solve the question, the paper actually, which has come in May-June 2025, variant 1-3. Unfortunately, I won't be able to get the variant 1-2 right now. As soon as I will get it, I will upload the solution for that also. So May-June 2025, variant 1-3, AS Accounting, MCQS paper, P1, May-June 2025, which was held on 4th of June, and variant 1-3. Let's start the question. What are the disadvantages of operating as a, just a minute, okay. What are the disadvantages of operating as a partnership compared to operating as a sole trader? So partners, what are the disadvantages of operating as a partnership? Partners may be liable for the action of the other partner. That's obviously. Partners have to be shared, profit have to be shared between partners. Obviously, every disadvantage is it. There is a risk of dispute between partners. That is also true. So all of the three are the disadvantage of being operating as a partnership. So A is the answer, 1, 2, and 3. Let's move forward. A business has the following balances at the end of a financial period: non-current assets, trade receivables, trade payables, profit for the period, drawings, and long-term loan. We know that we have studied that accounting question says that capital, because the question is, what is the closing balance on the owner's capital at the end of the financial period? Remember this, that all these items which are given, they are at the end of the period, assets and liabilities. Here it is written at the end. So closing balance on the owner's capital means that you need to find the ending capital, which is capital is equal to assets minus liabilities, right? Asset minus liability is equal to capital. So let's calculate it. 1,02,000 non-current assets plus trade receivable, 39,000. And the trade payables has to be subtracted because it's liability, 27,000. Then profit for the period, long-term loan is a liability, that is 50,000. And you will get the answer for the closing capital, which is 64,000. This 64,000 basically includes profit and subtracted, drawings has also been subtracted from that. And whatever is going to be the opening capital, profit is added and drawings are subtracted. And the capital at the end is now 64,000, including profit and after subtracting drawings. So closing capital is equal to asset minus liability. So 64,000 is the answer. Let's move forward. MCQs number 3. A sole trader uses the double entry system to record their business transactions. Which transaction does not allow the double entry rules? Which transaction does not allow the double entry rules? An expense account is debited at the end of the year when there is an expense prepaid on that date. The capital account is credited when the sole trader introduces their personal computer to the business. Obviously, when an asset is introduced by the owner, capital is going to be credited. Provision for motor vehicle depreciation account is debited when a motor vehicle is sold. Yes, the entry is provision for depreciation to vehicle disposal account. And the first entry is vehicle disposal to asset account. Purchase account is credited when the sole trader draws goods for the business. That is drawings debit and purchases credit. That is also fine. So A is the answer because that transaction does not allow the double entry rules because it is wrong. Because expense is debited, we know that. But when there is a prepaid expense, the entry will be prepaid expense debit and expense credit. So we need to credit the expense account or the amount is subtracted from the expense account. But here, unfortunately, we have debited expense and expense is debited at the end of the year for prepaid expense, which is wrong. So A is the answer, which does not allow the double entry rules to follow. A business owns a property which is rented out to tenants. Which of the following costs should be treated as capital expenditure? Extending the kitchen area. Obviously, kitchen area extend karenge. There are more people will incline towards that property. There can be increase in the earning capacity. A non-current asset is acquired, right? Business will be extended. Legal fee for a 5-year tenancy agreement. That is 5-year tenancy agreement means that it is supposed to be paid every year. Repainting the property is also an expense, right? And replacing a water pipe is also treated as an expense. So I personally believe that which of the following costs should be treated as capital expenditure it is not the extending the kitchen area, because extension of the kitchen area will not result because a business owns a property which is rented out to tenants, right? So kitchen area, extending the kitchen area will not makes a non-current asset has been installed or erected, or it will increase the earning capacity. I don't think so. So I believe that B is the answer. The student has done it wrong. Legal fee for a 5-year tenancy agreement. Why? Because the legal fee has been given at the start of the agreement, and the benefit of this legal fee is supposed to be taken for the 5-year tenancy agreement, right? So it will be for 5-year agreement. So the benefit is for more than 1 year. So for me, B is the answer. Why? Because the legal fee, whatever we are paying, the benefit for this expense is for more than 1 year. So when the benefit gives us, when the benefit is for more than 1 year, or as you say that for a 5-year tenancy agreement, that legal fee is a one-time expenditure for that particular era. So that is going to be a capital expenditure. So A is not going to be the answer. B is the answer for this question. Okay, let's move forward. Now the fifth MCQs. Let's see. Okay. Which statement describes factors that may cause a non-current asset to depreciate? A reduction in the estimated residual value of the non-current asset, the introduction of new technology making the non-current asset obsolete. You know that obsolescence is basically a factor causes of depreciation, because that's what the question is basically requiring us. So introduction of new technology making the non-current asset obsolete, it is cause. A change in the estimated useful life of the non-current asset. No, useful life doesn't mean any sense. Physical deterioration due to increased use of the non-current asset, that is also the cause of the depreciation. Physical deterioration and obsolescence. So 2 and 4 is the answer. So D is the answer. A business purchased a non-current asset which had estimated life of 10 years, 6. It is depreciated using the straight line method. At the end of the sale, 5-year depreciation had been charged. The following information is available. So the estimated life is 10 years, but the cost of the asset is 1 lakh minus estimated residual value is given 20,000 divided by 10, because the life is 10. So the depreciation is going to be 8,000. As we know that 5 years have passed, and after 5 years the asset is sold. So 8,000 into 5, 40,000 is going to be the depreciation. So currently the book value of the asset is 1 lakh minus 40,000. So that is going to be 60,000. So 60,000 is going to be the book value of the asset. And we have seen that we are going to have a loss of 10,000. So there is a loss of 10,000. So it looks as if that the book value, the asset has been sold for 50,000. Zara, please keep it in mind and just focus on that more. 60,000 is the book value. Okay, we have a loss of 10,000. It means that the asset is sold at 50,000. Then we have a loss of 10,000. What the examiner has asked us, what were the sale proceeds? He wanted us to find the sale proceeds of the asset. But problem is this, that there is a selling cost of 8,000. That is also an expense which we need to incur. And then we are going to have a loss of 10,000. So it means that the asset is sold for 58,000. How, sir? I tell you, out of 58,000, you have to subtract the selling cost of 8,000 first, right? And the value will become now 50,000, and then it is 60,000 of the asset is sold for 50,000, and we have a loss of 10,000. So this is how, because from the sale proceeds, selling cost also needs to be subtracted, because that is also a selling expense which we have to incur by the sale of that asset. So the asset is sold for 58,000. C is the answer. Why? Because we have incurred selling cost of 8,000. So we are getting 50,000. And the book value of the asset is 60,000. So we have a loss of 10,000. Okay. So C is the answer, 58,000. I hope you got the point. 7 now. A business maintains control account as part of its double entry system. Which error would cause an entry in the suspense account? A purchase general total 9870 is incorrectly posted as 9780, right? Carriage outward is credited to the carriage outward account but correctly accounted for in the cash book. Discount allowed are debited to the discount allowed account and credited to purchase ledger control account. C, we have to debit discount allowed and we have to credit SLC. We have credited PLC. So PLC is debited, SLC will be credited. There is no suspense. Repair to vehicle are debited to vehicle account. Again, there is no expense, no suspense. B is the answer because carriage outward is an expense. It is debited. We have credited carriage outward. So now the carriage outward is supposed to be debited by double the amount twice and suspense is going to be credited. So which error would cause an entry in the suspense account? So B is going to be the answer. Though it clearly looks that B is going to be the answer for this particular MCQs number 7. But answer is B, but I am still in doubt with A also. Why? Because A is not properly explained in the question. If I will say you, a purchase general total of 9870 is incorrectly posted as 9780. So basically they were talking about posting error. So it means posting error means that it is wrongly posted in the purchases account only. So if purchases account is basically recorded less than the actual amount, so it will be subtracted or it will be added, purchase will be debited, suspense is going to be credited. But here he basically makes you understand that it is posted 9780 to both the purchases account and the purchase ledger account. This is an assumption which he is taking actually. So this is how we are getting the answer B. Okay. Just wanted to clear that particular thing for you so that you might not. Next is, which item is not likely to be updated in the cash book when preparing the bank reconciliation statement? So direct debit obviously comes in the cash book on the credit side. It is a payment. Dishonored check comes on the credit side. It is a payment. Standing order comes on the credit side. It is a payment. Unpresented checks goes to bank reconciliation statement. It will not affect cash book. So D is the answer. A draft statement of financial position shows a bank balance of 1400. The following information is now available. Check issued but not yet cleared by the bank. Sometimes the examiner and the teachers used to tell you that when there is a word used uncleared, not cleared, it is not credited checks. No, that's not the case. Right? आपको question को दुम से पकड़ना है. Check issued means that they are issued in favor of a trade payable. They are issued to those person to whom the payment is supposed to be made. Right? So that is the unpresented checks. Bank charges not entered in the cash book 45 and lodgements means check deposited in the cash book but not on the bank statement. They are uncredited of 220. So first of all, from 1400, if you prepare the cash book, T account, from 1400, which is the balance brought down. Why, sir? Because if nothing is mentioned, we treat that cash book or bank has a debit balance of 1400. So 45 bank charges will come on the credit side. It will be subtracted, whatever be the answer. Let me write it down rather, it will be more feasible for us. 1400 minus 45, that is 1355. That is the corrected balance of the cash book. Then, because it's a debit balance not presented, will be added plus 150. Not credited is going to be subtracted minus 220. You will get the answer. That is 1285. A is the answer. Okay. Which item should be recorded as a debit entry in a sale ledger control account? Contra entry between the sale ledger and purchase ledger comes on the credit side of control account, SLCA. Interest charged is the right answer because it comes on the debit side of control account. Bad debts comes on the credit side. Sales return also comes on the credit side. Interest charge means trade receivable debit, interest credit. It is an income and trade receivable is going to be debited. Some errors are made when preparing a purchase ledger control account. The incorrect balance was 15830. The following errors were discovered. Refund of 270 from credit supplier had been omitted from the control account. Total of discount received 480 had been posted to the wrong side of the control account. So let's prepare the control account, corrected control account, you can say. 15830 is the balance brought down. Okay, that's fine. It is written here. Because it's a trade payable account, purchase ledger control account is always having a credit balance. So 15830 will come on the credit side. Refund of 270. What is going to be the entry? Bank debit, cash debit, trade payable, credit. So it will come on the credit side of the control account 270. Then total of discount received 480 had been posted to the wrong side of the control account. Discount received, when there is going to be discount received, it is going to be debited in the PLCA. Wrongly, we have given it a credit. Now it will come on the debit side by the double amount. So this 270 is basically wrong by the student. And the 480 written twice on the debit side is fine. So let me calculate it. 15830 plus 270. Total of the credit side minus 480 minus 480. 15140 is the answer. So C is going to be the answer for this question. Okay. Let's move forward. MCQs number 12. Delete it first. All the things. I can use it. Oh. ओपन करें हम. Okay. So next is the following errors were then discovered. Just a minute. Why it's creating a problem for me. Okay. MCQs number 12. The draft profit for the year of a business was 84,000. The following errors were then discovered. Discount received 2,500 had been debited to discount allowed account. Wages of 9,000 had been completely omitted. Sales return of 8,000 had been debited to purchase return account. What is the corrected profit for the year? So the profit, incorrect profit you can say is 84,000. Discount received is an income. It is credited. Had been debited to discount allowed account. So let's make a sense of it. Discount received is credited by 2,500. We have debited discount allowed account. So what will happen? Discount allowed or discount is going to be credited with the double amount. You can say like this, that discount allowed will be credited by 2,500. Okay. Discount received will also be credited by 2,500 and suspense is going to be debited. Next entry, wages 9,000 completely omitted, wages debit, and you can say suspense or accrued expenses, accrued wages are going to be credited. That is the liability. Sales return had been debited to purchase return account. So sales return, we have debited purchase return is credited, sales return is going to be debited. So it will not affect profit. So 84,000, both the things, discount allowed and discount received are credited, profit will be added in profit. 84,000 plus 5,000, 89,000 minus expense are debited, profit will decrease. 80,000 is the answer. So D is the answer for this particular question. Okay, so D is going to be the answer for this question. Next is, which item would increase the profit for the year? Increase in allowance for irrecoverable debts? No, that will decrease profit. Decrease in allowance for irrecoverable debts? Yes, it will increase profit. Increase in prepaid rent expense? It will also increase profit. How? Because prepaid rent means that you have to subtract that amount from the rent expense. So it means expense is going to be credit, expense is decreasing, which will increase profit eventually. So 1 and 3 is going to be the answer. So C is going to be the answer for this question. Next is going to be the 14. Sam was unable to conduct a physical count of inventory at 31st December. This question basically belongs to that you have to go reverse because you need to find the value of closing inventory at 31st December. Okay, you need to find the value of closing inventory at 31st December. And we have been given the value of closing inventory at 31st December 2024. We need to find, and the value which is given is on 5th January. So it means that from 1 to 5, there are transactions which has already been happened, and we have to go reverse that transaction. We need to reverse those transactions, right? We have to give a counter effect for those transactions. So 59750. On 3rd January, what happened? Inventory was sold for 950. The cost price of this inventory was 9560. So remember this, that on 31st December, this inventory has not been sold. Yes, so it means that it is going to be added back. So because it is not being sold on 31st December, the 59750 plus 9560, we are supposed to add the cost price. Okay. On 4th January, inventory has been returned by Sita. It has been sold on 21st December 2024. The cost price of this inventory is 1912. So there is a sales return, but this return has been, that inventory has been returned to us on 4th January. On 31st December, they were not being returned. If you have added that in your 59750, 5th January of inventory, it has already been added in 59750, whereas it was not a part of the inventory on 31st December. So we need to subtract it. Minus 1912, we will get the answer 67398. So C is going to be the answer. 15. Why does a sole trader account for accrued income? So that current liability are not overstated, so that current liability are not understated. Accrued income is a current asset, beta. It has nothing to do with current liability. So that profit is not overstated, so that profit is not understated. So the entry for accrued income is accrued income debit, and income is going to be credit, right? So if you will not record income under accrual concept, because when income is earned, we will record that income either it is received or not. So your profit is going to be understated. Why does the sole trader account for accrued income? So that profit is not understated. So that we should record, add it in the profit, so that profit is not understated. So D is going to be the answer for this particular question. So 15 we have done. Next 15 we are supposed to do, which obviously include the, what should I say, marginal costing and absorption also. Let's see. The following information is available for a sole trader's business at the end of the financial year. Cost of sales 5,40,000, expenses 3,25,000, profit for the year, sales return. What was the total sales figure for the year? As I discussed with you in my MCQs guess, very clearly I stated that the MCQs paper for O levels and AS are going to turn, they are getting easier. So you don't need to worry for the MCQs paper, but I would recommend you people for MCQs, if you want to prepare the MCQs, you can prepare MCQs in just 10 to 15 days, right? Either from the, yearly papers, you can do that. If you have strong grip on paper 2, you can do that from yearly paper. But if you don't have a strong grip, then I would rather recommend you to go for a book for Numan Malik Saab. Numan Bhai ki book se aap padh sakte hain. It is very helpful. Why? Because he has segregated the parts. He has segregated the parts from each chapter. He has segregated individual parts from each chapter. So that is a wonderful effort from him, and I regard him for that. So you can use that. So sales figure, how you will find the sales figure? Profit is given. Profit plus expenses, you will get gross profit. And gross profit plus cost of sales, you will get sales. But unfortunately, we have sales return also. So now what you are going to do, you have to go reverse. Profit plus expenses plus cost of sales plus sales return, you will get the total sales figure which is 9,58,000. Okay. A partnership maintains both capital and current account for its partners. What is the correct accounting entry for recording interest on capital for partner X? Sometimes we believe that interest on capital is an expense. It is an appropriation actually. So what will happen? Profit and loss appropriation account is going to be debited and X current account is going to be credited. Why? Because interest on capital is subtracted from the profit for the year. That is why profit and loss appropriation is going to be debited as an expense, and current account is going to be credited because interest on capital will increase X current account, because business has to give that interest on capital to partner X. So it will increase his current account. So B is going to be the answer for that particular MCQ. Okay. Let's move forward. Just a minute. Okay. So Amold is a partner with Bradley. The financial period on 31st December ends on 31st December. One of the terms of their partnership agreement is that interest is charged on drawing on a monthly basis at the rate of 5% per annum. Amold made the following drawings during that year on the date specified. So let me clear you the MCQs, which is very easy actually. Normally, we used to calculate interest on drawing at the end of the year. But here, Amold is basically going for drawings during the year, and he is going for drawings as calculation according to the monthly calculations. So the first drawings he has done is on 31st March. So if he has made drawings on 31st March, he doesn't need to pay interest before 31st March. He doesn't need to pay interest on January, February. He's supposed to pay interest after March. Why, sir? Because in January, February, and in the month of March, he has not gone for any drawings. So why he should be liable for interest on drawing, which is the income for the business? It will be added in profit for the year and appropriation, and it comes on the debit side of the current account. So 6,000 into 5% into 9/12. April, May, June, July, August, September, October, November, December. Then 30th June, he has gone for drawings. We have to charge interest on drawing for 6 months, 5% into 6/12. Then 30th September, October, November, December, that is also 5% to 3/12. And whatever drawings he has gone for 31st December, there will be no interest on that. because it is done at the end of the year. The total is 625. So 625 added to profit for the year. Because what is the correct treatment for interest on drawing in the appropriation account for the partnership? So interest on drawing is basically added in the profit for the year. So 625 is added to the profit for the year. Which statement correct in relation to financial statement of a limited company? Debentures are presented as part of total equity. Wrong, it's a non-current liability. Dividend paid is shown in the statement of changes in equity. Yes. Proposed dividend never comes, never been recorded. It is a footnote. The gain on revaluation is added to retained earnings. No, it does not come in retained earnings. It comes as a separate name of revaluation reserve. Okay. So we are done with 19 MCQs. Let's move forward for the 20th MCQs. Company provides the following information about its equity. 150,000 shares of $1 each, 1,50,000. Share premium, general reserve, retained earning is given. The director proposed to issue bonus shares on the basis of 1 share for every 3 already held. Okay, let's calculate. 1 for every 3. So we'll be having 1,50,000 divided by 3 because 1 share is basically value is 1. 50,000 is the amount of bonus share. Now the total shares are 2 lakh. 150,000 old shares. Bonus shares are 50,000. So 2 lakh is the number of shares now. Following this, the directors intend to make a right issue, where it is written, on the basis of 1 share for every 4 shares held at a premium of 0.2 per share. So divided by 4, again it is going to be 50,000. So now the share capital is going to be 1,50,000 plus 50,000 plus 50,000, 2,50,000. But we have a share premium also. The shares are 50,000 right shares and the premium is 0.2. So 10,000 is going to be the share premium, right? So we know that bonus share it is a conversion of reserves into share capital. It is also known as capitalization of reserves. And the amount taken for the issue of bonus share is from share premium. 50,000 will be added in the 1,50,000 and it will also be subtracted from 75,000. So listen, 150,000 plus 50,000 bonus shares plus right shares, it becomes 2,50,000. 75,000 minus 50,000 for bonus share, 25,000, and the share premium for right share, 10,000, it becomes 35,000. 1,25,000 is the general reserve, which will remain the same. Retained earning will remain the same. So the total equity is going to be 4,35,000. So B is going to be the answer. I will calculate it also. 2,50,000 plus 35,000 and plus. So 4,35,000 is the answer. That is the right one. Which statement about ratios are correct? Ratios are affected by accounting policies. Yes, because if you are using straight line method and you are changing the straight line method to the diminishing balance method, so your profit will be changed and your ratio, the value of the ratios will also be changed. Ratio can be compared with other businesses. That's true. Ratios generally ignore inflation. That is also true. We ignore inflation. Ratio include non-monetary items. No, ratio does not include non-monetary items. We used to go for the recording of only financial terms. Whole accounting goes for only financial terms. So 1, 2, and 3 is going to be the answer. These 3 things are absolutely right about ratios, that they are affected by accounting policies, can be compared and ignore inflation. Now, a limited company achieved a return on capital employed of 5% for the previous financial year. Equity is 10 lakh, 10% debenture 2 lakh, finance cost is 20,000, 2 lakh 10%, taxation is 10,000. What was the profit for the year? So I need to go for the formula actually. And the formula for this is basically operating profit divided by capital employed. You know the formula is equal to 5%, which is the percentage given. So we don't know the operating profit actually. Capital employed is equal to equity plus non-current liability. So equity is 10 lakh and the non-current liability is 2 lakh. So 12 lakh is going to be the equity. 12 lakh is going to be the capital employed, which is equal to 5%. So we can find the operating profit now easily. That operating profit is going to be 12 lakh into 5%. That is going to be 60,000. This is operating profit. Now I need profit for the year. I don't need operating profit. Return on capital employed ratio include operating profit from operation. So 60,000, we have to subtract the finance cost, 20,000, and we have to subtract the Taxation also 10,000 to get the profit, which is 30,000. So profit for the year is going to be 30,000 for this particular question. So 30,000 is going to be the answer. Just go through it, write it down, whatever you want to write, and then we'll move forward for the next MCQs. Obviously, they belongs to absorption and marginal costing. Sorry. Let's move forward. So let me wrap it up now. If you have any query, you can message me on the message board. You can WhatsApp me on my number 0333471287. I'm ready to help you. Anyways, now 23rd MCQs. A business rents machinery for use in its factory. The rental cost of a machine is 12,000. Each machine has the capacity to produce 60,000 units. The business provided the following information. I just want to make you very sure. This 23rd question usually comes from the labor costing. But in this variant 1.3, May June 2025 variant 1.3, we don't have labor costing question at all. Well, it didn't come in that paper. But this question always comes in the paper, and this is known as high and low point method. So please, I request you, and I request the teachers also, that please make sure that your students should know about high and low point method, which is how to differentiate between fixed and variable costs when total cost is given or semi-variable cost is given, which includes both fixed and variable cost. The business rents machinery for its use in its factory. The rental cost of a machine is 12,000. Each machine has the capacity to produce 60,000 units. So it means that if you are producing 60,000 units, your rental cost is 12,000. But the moment you will produce more than 60,000 units, either 1,20,000 or 1 lakh, you have to go for another machine and you have to pay the rental cost, which will double the rental cost, which will become 24,000. Okay. So if more than 60,000 units are produced, the rental cost is going to be 24,000. Till 1,20,000 units. If it will go more than 1,20,000 units, rental cost will again increase by 12,000. It is a stepped cost basically. So stepped fixed cost. I mean, the business provided the following information: 90,000 units, 5,10,000, 1,20,000, 2,660,000. So what we are going to do? Change in cost divided by change in units. This is how we are going to find the variable overhead rate. Variable overhead rate, which will not change for any level of activity. Change in cost, 5,10,000, difference in cost, 5,10,000 minus 60,000, minus 6,60,000, sorry. That is going to be how much? I think that will be 1,50,000. Sorry. Change in cost is 1,50,000 divided by change in units is going to be 30,000. So the variable overhead rate is going to be 5. Now I can use any of the activity level, either 90,000 or 1,20,000. Let's take 90,000. For 90,000, the total cost is 5,10,000. Less, I will subtract less variable cost from this to find the fixed cost. Variable cost is how I'm going to find 90,000 into 5. 90,000 into 5. Let me write it down. 90,000 into 5. That is going to be 4,50,000. So 5,10,000 minus 4,50,000. 60,000 is going to be the fixed cost. Okay. Now 60,000 is the fixed cost, which will not change in total. 24,000 is the rental cost. So 84,000 is going to be the total fixed cost to produce 1 lakh units. Because we are producing 1 lakh units. So for 1 lakh units, we just need to find the fixed cost. Fixed cost for 90,000, 120,000 units or 1 lakh units will not change. Will remain the same. That will still be 84,000. Let's take the other level of activity, 120,000. So cost of 120,000 is 6,60,000. Okay. Now let's subtract the variable cost from 6,60,000. 120,000 units into 5. That is 6 lakh. 660,000 minus 6 lakh, so 60,000 is going to be the fixed cost again, other than the rental cost. Rental cost is 24,000, so 84,000 will be the total fixed cost for this particular question. Okay. A company sells a product for 12 per batch. The variable cost is $4 per batch. It means selling price minus variable cost, $8 per batch is the contribution per unit per batch. Fixed costs are absorbed based on a normal activity level of 100 batches at $3 per batch. What is the profit under marginal costing if the company makes and sells 125 batches? Always remember that fixed cost in total does not change. So either you are producing 100 batches or 125 batches, fixed cost will remain the same. That will 100 into 3. So that will remain the same at 300. Now the contribution 12 minus 4 is 7, and we are producing 125 batches into 7, which is the into 8, sorry, which is the contribution per unit. Let me calculate the total contribution. That is going to be 1000. So 1000 minus fixed cost, profit is going to be 700. So C is the answer. Yes, it doesn't mean that your fixed cost will increase 125 into 3. No, because fixed cost is a cost which does not change with the change in the volume of production or in with batches, with the change in batches within a relevant range. So it is still in the relevant range because range is not mentioned. So 100 into 3 fixed cost will remain at 300. So 700 is the answer. Which statement correctly compare the benefits of absorption and marginal costing? Avoid the need to separate fixed cost and variable cost. Yes, absorption costing does not need to separate fixed and variable cost. We do it in marginal costing actually. Useful when there is a limiting factor affecting production. Yes, marginal costing is used when there is a optimum. We want to go for optimum use of resources, right? When there is going to be you have to accept a order below normal selling price, accept or reject decision, make or buy decision. We are normally using marginal costing. B is a recognized method of inventory valuation. That's true, but marginal costing ensure fixed costs are attributed to cost center. No, that is for absorption. Useful for determining selling price. Yes. Is a recognized method of valuing inventory. No. Useful for short-term decision making. No. Useful for, yes, useful for determining, useful short-term decision making is marginal costing. Useful for determining selling price is absorption costing. So A is going to be the answer for this particular question. Okay. Let's move forward. We are almost getting towards the end now. Thank you for keeping with me, staying with me. The following table shows details of a product for a week. Budgeted production overheads 1 lakh, actual production overheads 80,000, expected production 5,000 units. Expected production means budgeted production 5,000 units, over absorption of overheads 10,000. How many units were produced during the week? So let's calculate it. We know that for finding under and over absorption overheads, we compare actual overheads with, which is 1 lakh, which is 80,000, with absorbed overheads, right? Absorbed overhead, we need to calculate actual production into OAR, right? So actual production, do we have? No, we don't have. But we have over absorption, which is given. Over absorption is given, that is 10,000. Over absorption means that absorbed overheads are more than actual overheads. So it means that absorbed overheads are going to be 90,000. 10 plus 80, 90. That is why we are getting over absorption of 10,000. Now we have to calculate units. Sir, how we are going to do that? We need to find OAR first. OAR means budgeted overheads divided by budgeted hours, budgeted units. Budgeted overheads are going to be 1 lakh divided by expected production or budgeted units are 5,000. So the OAR is 20 per unit. So it means that whatever the units are going to be, it is supposed to be multiplied by 20 to get 90,000, right? So 90,000 divided by 20, we will get the units, and that is 4,500. Yes, we have to go reverse. 90,000 divided by 20 will get 4,500. That is going to be the units produced, 4,500. I'm going to tell you something, that if you see the last May-June attempt and the last year papers of 24 also, in every MCQs, in every paper, they are going reverse. They are going for the reverse calculation, right? So this is common nowadays in your AS exam or for your AS exam. So this is done. A business has produced the following budget: revenue 7 lakh, contribution 5,60,000, fixed production cost 3,50,000, fixed non-production 20,000. What is the budgeted break-even sales revenue? What is the budgeted break-even sales revenue? Revenue sales lakh, contribution 5,60,000. All remember that when we find budgeted break-even, we take total fixed cost, not only fixed production or not only fixed non-production, total fixed cost. Either it belongs to production or it belongs to non-production. So the total fixed cost is going to be 3,70,000. Now for sales revenue, we need to find contribution to sales ratio. And contribution to sales ratio is 5,60,000 contribution to sale, contribution to revenue, contribution divided by sales. So 5,60,000 divided by 7 lakh, that is 0.8. So 3,70,000 divided by 0.8, we will get the answer. We will get the budgeted break-even sales revenue. Let's divide by 0.8. Let me calculate it. 462,500. So D is going to be the answer. Here it is. 462,500. Right? We can't go through by units. I mean to say that we can't use this formula that said how can we calculate break-even units into selling price? No, because of the reason that we don't have units available over here. Contribution per unit we can't find. That's the problem we are facing in this question. Okay. Let's move forward now. I hope you got it. Not that difficult. Just you know the formula of the break-even. How a margin of safety is calculated. Actual total contribution minus break-even contribution. Actual total contribution minus budgeted total contribution. That is not obviously. Budgeted total sales unit minus actual total unit. No. Budgeted total sales minus break-even sales. So you know that margin of safety is basically actual sales or budgeted sales minus break-even sales, and margin of safety in percentage, budgeted sales units minus break-even sales units divided by budgeted sales units into 100, you will get the margin of safety in percentage. So it's quite easy. Now let's last two MCQs. A business has contribution to sales ratio of 40%. The following information is available. Sales revenue 1 lakh, fixed cost 30,000, profit 10,000. It is predicted that the sales revenue will increase by 20% next year. Total fixed cost will remain unchanged. What will be the increase in the profit? So let's do that. Sales revenue will increase by 20% next year. Okay. It means that the sales revenue, it will be now how much? Yeah. It is going to be 20% of 1 lakh is going to be 120,000. So sales revenue will be 120,000 because it is increased by 20,000. Total fixed cost will remain unchanged. So there is not going to be any change in the fixed cost. That will remain the same, right? What will be the increase in profit? So let's calculate the variable cost basically, or the contribution ratio, which was in the past, which was available already in the past. Profit plus fixed cost. Profit plus fixed cost is going to be contribution. So that is going to be 40%. How come, sir? Beta profit plus fixed cost is 40,000. So 40,000 divided by 1 lakh, it means 0.4 is going to be the contribution to sales ratio. So we know that contribution to sales ratio will not change because variable cost per unit does not change, right? Selling price does not change. Total sales is changing actually. So 1,20,000 into 0.4 will be our now contribution is going to be 48,000. Minus fixed cost will remain the same, 30,000. That will not change, right? So increase in profit now 48,000 minus 30,000. Profit is going to be 18,000. Profit is 18,000, but increase in profit, previous profit was 10,000. Now the profit will increase in the profit is 8,000. The profit will increase by 8,000. Okay. I repeat again. It is predicted that the sales revenue will increase by 20% next year. Total fixed cost will remain unchanged. 10 plus 30, 40,000 is the contribution. And on the above, you see, here it is written. Just a minute. A business has a contribution to sales ratio of 40%. Okay. It is given that contribution to sales ratio is 40%. It is not changing. Sorry, I didn't see that earlier. Contribution to sales ratio is 40%. It is not changing. So if the sales will increase by 20%, it will become 120,000, and 1,20,000 into 0.4, 48,000 now is going to be the contribution. Minus fixed cost will not change. Profit is 18,000, 8,000 increase. The actual output for a business is lower than the forecast. Actual output is lower than the forecast. Total, which costs are usually the same as forecast, right? Fixed cost per unit, total fixed cost, total variable cost per unit. Actual output for a business is lower than the forecast doesn't make any sense. Either it is lower or higher. We know that total fixed cost does not change at any level of activity, and per unit variable cost does not change at any level of activity. It's quite an easy answer. So the answer is variable cost per unit and total fixed cost, 2 and 4. So C is going to be the answer for this question. So we are done with this MCQs with this paper. May, June 2025, variant 1-3. We are doing this and we are done with the paper. I hope so that you got it correctly and this is not that difficult. Thank you very much for your listening. Feel free to ask me any question if there is a need. Thank you very much for your time and effort. See you in the next class, inshallah.